Financial news coverage often looks like this, a high-speed frenzy of flashing tickers and shouting traders, all centered on one goal: beating the market. The industry thrives on market timing and active stock picking. They encourage high-volume activity because your frequent transactions generate their commission fees. However, wealth accumulation follows a strict mathematical equation rather than the ability to time a trade. Once you understand the variables in this equation, your approach to allocating capital changes. We are going to build a personalized 5-point checklist to apply this math to your own life. Grab a pen and paper or open a blank digital note. Shifting your focus from unpredictable market returns to this mathematical framework is the most reliable way to systematically scale your net worth. Start your list with this. Write down Step 1. Maximize early starting capital. This equation dictates your financial outcome. W0 is your starting capital. Over 30 years at 10% returns, $10,000 grows to $174,000, while $100,000 becomes $1.74 million. The gap widens every year. Wealth is multiplicative. Higher starting capital yields exponentially more money. Next, write down Step 2. Manage volatility before optimizing returns. The pi symbol means returns are multiplied across time, creating path dependence. Volatility is destructive. A 50% loss on $100 leaves $50. A subsequent 50% gain only reaches $75. You are still down 25%. Preventing deep drawdowns is a mathematical requirement for wealth. Negative volatility actively erodes the multiplier, making it harder for your capital to recover and compound. For the third item, write down Step 3. Shift income to equity. The S variable is the scalability factor. It differentiates linear and multiplicative income. Selling your time for a wage is an additive process. Owning equity in a business allows your wealth to grow independently of your personal labor, scaling your exposure to returns. You can access equity through employee stock purchase plans, profit-sharing agreements, or private venture stakes. These instruments turn your work into a compounding asset. Selling hours is a single gear spinning in isolation. Owning assets connects you to a self-propelling system where moving capital drives your growth. Without a transition to scalable income, your earnings stay tethered to your schedule. Your potential is limited by the physical constraint of a 24-hour day. Add the fourth item to your list. Step 4. Build S-enhancing infrastructure. Professional networks and information advantages function as scaling factors. They provide access to deal flow and opportunities that are not available to the general public. A solo retail investor is an isolated node. A highly connected participant sits within an interconnected web, receiving data pulses and deal opportunities that multiply the effectiveness of their capital. Finally, write down Step 5. Stop obsessing over daily returns. Optimizing for peak returns is the lowest priority on this list. Realized returns are high variance and often influenced by market noise that you cannot control. Leverage is found by taking control of your starting capital and your scalability factor. These are the inputs that drive the math of wealth. The 5-point list you have created is a mathematically sound framework for prioritizing ownership. It focuses your attention on the variables that actually move the needle. By following this plan, you move away from the high-stress game of active trading and toward a more systematic approach to growth. Your first task is to audit your most recent paycheck. Calculate your ratio of additive wages compared to multiplicative equity. Identify one tangible action you can take this week to increase your ownership stake. Whether it is adjusting your 401k or negotiating for equity, move the ratio in your favor. Wealth is not a matter of predicting the future. It is a result of deliberately engineering exponential starting conditions today.